I bet. So we'll be talking about all the blocks today. So we'll be talking about the order blocks, the rejection blocks, the breaker blocks, and the mitigation blocks. So let's get right into it. I guess we'll start off first with order blocks. So the idea with order blocks is that on our way up, we're gonna have, and let me do this drawing first. So on our way up, we're gonna have bearish candles support us higher in terms of here and then here, right, to continue higher. So that's the idea behind order blocks, and we'll kind of go over that in just a second. And then same on the way down, except we'll be using our bullish candles to support us going lower and acting as that resistance. So let's look at a couple live examples, and then there's a couple things I'm going to point out here. So this light shaded blue area right here is a weekly BISI or a weekly fair value gap, bullish fair value gap here. And when you're inside of a higher time frame PD array, this is a 1 minute chart, you're going to use every single consecutive down close candle here, and this is going to be your order block. Now, what do we exactly need to classify an order block, especially a high probability order block? Well, you want to look for, generally, you want to look for a sweep here, a sweep of liquidity right here. Once you see that sweep in here, and if you are in this higher time frame or a PD array, another PD array, and you have a series of down close candles like this, all of this is now classified as your order block. The wick can be classified as your order block, but the most sensitive part of the order block here will be this down close candle right here. And on the body, just like that, you can see price comes into it. How can we classify a further higher probability order block? Because once again, not all up close candles and not all down close candles can be considered order blocks. Well, we can classify that by having a fair value gap here. And now we can trust that this is our order block here. You can see the body stay above it. Now, what will be our next order block here? What can we consider our next order block? Since not every order block is going to be, or not every down close candle in a bullish trend is going to be considered an order block, right? We have to look and see what is going to be our order block. And that's going to be, in this case, that's going to be this one right here. And you may be asking, why would it not be this candle right here? And I'll tell you why it's not this candle right here. It's because, first of all, when after coming into this fair value gap here, right? Or actually before we even came to that fair value gap here, the high of this candle was not traded to right here. This high was not traded to. So we cannot classify this as an order block if we have not seen this high traded to, although the body closed above this body here. So I'll do a quick drawing here real quick. So let's say this is your bearish candle here acting, and you want to see it act as a bullish order block, right? In order to see that it act as that bullish order block on the next candle here, which will be a bullish candle, right? You want to see first price trade above the high here. Once it trades above the high, it doesn't need a close above the high. It will be much more preferred if you do see it close above the high, but it doesn't have to. It just has to trade above the high and close above the body here, and then this will be considered your order block. So that's the basis of what I'm going off of for this order block here. So this we can't consider an order block now, right? So we're going to look for our next down close candle to be considered the order block, right? And it isn't considered the order block until we have this candle here, right? Because this candle not only trades above it, doesn't need to close here, right? But it trades above the high of this candle here, which I'll draw out here, above the high of this candle here, right? And closes above the body of this candle here, right? So even if we did get this one tick close above this body right here, but since we did not come and trade above this high here, we cannot classify this as our order block yet until we trade above that high with a wick or with a body close. So once we have that body close and that wick trade above here, we can now classify this as our order block, and you can see price come taps into it and leaves again. Now we can move on. Oh, actually, I guess I forgot. We can also talk about our propulsion blocks. So our propulsion blocks are going to be after price comes into an order block, a body needs to close above the order block. So you want to see, generally, you want to see your first formation order block here in your smart money reversal here. Then you're going to see an order block touch that order block in a fair value gap, and it's going to create another order block. After touching this order block and creating this order block, the next down close candle that comes into it that we can validate as a proportion, validate as an order block, becomes a proportion block. And the slight difference between a proportion block and a order block here is that instead of the most sensitive point of a proportion block being the body, it's going to be the consequent encroachment with the 50% level. And this is going to be the most this is going to be the most what do you call that, sensitive area of that proportion block. So you can draw out your proportion block as something like this. Now you can draw it off the body if you want to, but the idea mainly behind the proportion block is that you want to see it, just like fair value gaps, stay in the upper half here since it is classified as a proportion block. So you want to see that strength come in here, right? So what I recommend for proportion blocks is you guys either use the consequent encroachment of it or you guys use the wick, whichever you guys so choose to do so. But there is absolutely nothing wrong with using the body here. The body is just as good, but just note that if you see this proportion block price, depending on how heavy it is, may not come and touch the body. Okay, so do we have any questions about the proportion blocks or order blocks of that so far, whether it comes to the creation of it, what the order blocks are, anything like that? Cool. Now we'll go on to talk about the mean threshold of the order block. So when it comes to blocks, it's a little bit different than gaps. Blocks will use something called mean threshold, and that's what we'll use to calculate the 50% of it. So just like here, we have this order block here, right? Now, this is one thing you can either choose to do or not do here. Since we have our inside of this weekly, right? What did I say about being inside of this weekly here, right? If we are inside the weekly, you want to use, or inside a higher time frame PD array like a fair value gap or something, you want to use the consecutive up close or down close candles, which we'll put it here. However, since this candle is not inside of this weekly fair value gap here, in this case, we're just going to be using this candle as our order block here. Right now, you can technically classify this here as your order block, but since for me, at least personally, it is no longer in this weekly fair value gap here, I would not consider this the order block. Now we can measure our mean threshold. Now with the mean threshold, you can measure it either from the bodies like this or from the wicks like I showed before, right? It's really up to you, and it does not matter too much, as generally they will be in the exact same location and it's not going to be too important. But if we wanted to consider this our order block here as well, if we wanted to use the consecutive candles here, we can see it looks something like this if we were to use the bodies, right? So there's that for you, but for now, I'm going to say this is the order block because we are not in that weekly fair value gap. Now we can look over here and we can look at this order block here again, right? And we can look at what is our rejection block. Well, our rejection block simply is in an order block or in a leg up. The top of your order block is going to be your order block, and the bottom of it, whether it be, actually, it's a pretty bad example, like something like this. And the bottom of it here will be your rejection block here, and vice versa for bullish and bearish, right? So in this case, our rejection block will be down here, right? And you can see price come into this rejection block here. In the case of this order block here, which we can consider this an order block, right? We can consider this your rejection block, or you can consider this your rejection block here. We don't quite come into that, but we can consider this our rejection block off of this order block. And now this will be also considered an order block on top of this one and this one. These would be two order blocks here. Do we have any questions about rejection blocks or order blocks so far? Yeah, for sure. Yeah, you guys don't have to wait until I do something. Yeah, yeah, I use order blocks. I use order blocks all the time for entries. and I don't specifically use them on like any time frame specifically to take entries. I'll take them on every single time frame, whether it's a 30-second, 1 minute, 15-second, 5 minute, 10 minute, 15 minute. I use them on all time frames here. And but more I use them more on the 1 minute chart when it comes to taking entries because most of my entries will be on that 1 minute chart. Yeah, so there is a good way to tell, and that would be looking for your high probability order block, and that's going to be when there is a fair value gap aligned with it. So this is actually what I'm going to go over right in my next example here. Remember we talked about here, we saw this sweep in liquidity here, and then we came and created this order block with aligned with a fair value gap here. This is going to be your high probability order block, and this is going to be the order block that is going to hold more often than not compared to an order block like this or an order block like this or something of that nature. Does that make sense? And I'll go over it in just another example here, but that's pretty much the idea behind it. And the main idea behind order blocks is that bearish candles are going to hold price up, but not every single bearish candle here is going to be considered your order block, as generally you want to either see to have a continuation order block, which is basically just an order block that happens after this smart money reversal area, is you want to see it either sweep liquidity or come into another PD array. So in the case of a propulsion block here, right, we can see we came into this fair value gap in this order block. This led to this order block being created, and we know that this order block is going to hold, right? Since this propulsion block here ended up coming into this order block here, we know that this one is going to hold here. This one is going to hold here. Now, this one is kind of a hard read because this is going to be this is a doji candle here, so you can't really tell whether or not that's going to be a bullish or bearish candle. But since we have this weekly fair value gap here and we are kind of coming out of this proportion block, now if this was a blue candle here, this would not be considered a proportion block, and if this was a black candle here, this would be considered a proportion block. Whenever I see dojis that come into a proportion block or an order block that's going to make a proportion block, I just consider it an order block just because it's really hard to tell. But once you see this come into another PD array here, right, you can tell this order block is going to hold. Now we look at this order block here, right? We can technically classify this as an order block. However, this order block has not come into any PD array, swept any liquidity, or did nothing. So we can see why exactly this order block didn't work as well as an order block like this, or an order block like this, and an order block like this. Now, if we were to draw our mean threshold, we can still see the body stay above and stay above it here as well, but just keep that in mind there. Now, when it comes to coming into this one right here, right? We can see that we have this rejection block here that we came into. So, sorry, I used the wrong. We have this rejection block we came into here, right? Which is once again the bottom of an order block being created here, right? So we can classify this as a PD array. We can also classify it coming down one more time to come into this weekly BISI here, right? And now we rally. Now, what can we consider our order block? Are we going to consider it this high? Yes, we can 100% consider it this high if we wanted to. However, for me personally, I would probably consider it here, as this, once again, is aligned up with your fair value gap right here. And generally, you want to see your order blocks align up with your fair value gap here. But by definition, 100%, this would be your order block right here. Yeah, I can go over rejection blocks one more time. But real quick, do we understand? I just want to make sure everyone understands that. How do we classify order blocks in terms of something like this, right? And once again, I know here I said that only when we're in a higher time frame PD array, we're going to use the consecutive down close candles up here, down close candles to use the order block. It would be the same thing here if we align with a PD array, which would be here, right? We align with the PD array right here, so this can 100% be considered our. Yeah, so generally this is how your smart money reversal is supposed to work here, is that when you're in an uptrend here, you're going to see your smart money reversal occur something like here. And the first kind of PD array that it's going to tap into before even making the smart money reversal is there's going to be a bullish order block or a bearish order block in this case that forms right here, and you're going to see this come into right here, come into play right here, and this is going to be your very first order block that forms, right? Because the idea behind your smart money reversal or your buy model is that there's going to be, hold on, let me just make this into shift and structure, right? There's going to be a higher time frame PE array or something here. Maybe for the sake of it, since we're doing blocks, I'll say a rejection block here, right? Let's say there's a rejection block here. Using the wrong fucking one. Okay, let's say there's a rejection block right here, and price came into this rejection block, right? And we saw price come down here, create this order block right here, come down and shift structure. This is your first sign that we have this is your first sign that we might have started a reversal point, and your order block, this order block will basically be your change in state, which we can go over that later if we want to. But this order block is going to be your first sign. You're going to see that happen. After you see the order block happen, you're going to see that shift in structure. After you see the shift in structure, is you're going to see your breaker block and your fair value gap. Now, in a perfect world, in a perfect scenario, this is exactly how your smart money or your MMXM is going to go here, right? It's going to come up here, come into the rejection block, come create an order block somewhere here, come into the order block, come into a fair value gap, shift structure, come into this, in this case, this shift in structure would be your breaker block, come into the breaker block, hopefully aligned with a fair value gap, continue lower, come back into your mitigation block, and continue lower. So the idea behind it is it comes into a rejection block, and now this is your picture perfect market maker model here. Comes into a rejection block or sweeps liquidity, either or, right? One or the other. Comes, forms an order block, comes into an order block, breaks down, fair value gap right here, breaks down, shift structure. This shift in structure is also going to act as your breaker block here, right? Boom, come down. Inside this shift in structure, you're going to make a low here. This is going to be your mitigation block. I don't have a block for mitigation, but this is going to be your mitigation block. And then price is going to ideally come back into it one more time and then fall. And this is your picture perfect market maker model. And back, it's going to fall back down to your OC or your original consolidation here. And this is your picture perfect market maker model. So in terms of using OBs as a draw on liquidity or reversal point, generally when I see something like this happen, sweep liquidity here and come into some kind of PD array, ideally fair value gap or rejection block here, and then make this order block react off of it, then come into a fair value gap. Now I know that chances are we are going to come and shift the structure, come and make this breaker, and then come into the unicorn. Does that kind of answer your question there, Wavy? Yeah, for sure. So for rejection blocks, I'm gonna go into a higher time frame here, just so things are a little bit more clear when it comes to things. So again, your rejection block is going to be your order, the bottom of your order block here, right? And it's gonna be the a low or the high of a range. So it's gonna be your swing high or swing low of a range here, right? In this case, this was our rejection block here, right? You can see we can draw that out there, and you can see price came right to the bottom of this rejection block here. And in the case where you have a kind of imbalance here, right here, your rejection block would be this whole imbalance here combined into one here. Right now, this can be a rejection block or a volume imbalance, whatever you guys would like to consider it here. But boom, this will be a rejection block, this whole block here. And that's more or less your rejection block. This is going to be your bullish rejection block here. And if we wanted to look at our bearish rejection block, right, it would be at the high of here. And this would be our bearish rejection block here. Right, and I'll see if I can get a better example of a bearish rejection block if I can here. I'm not too sure if I'm going to find a really good example because rejection blocks ideally just aren't used that much. But they're definitely a good thing to have on your chart. It's just hard to find a really good one like this. Yeah, but yeah, nothing to really see here. Yeah, there's no really good bearish rejection block here. if you want to technically say, like this is technically a rejection block, right? And you can see we had a little bit of resistance getting above here. But yeah, that would be a rejection block there. Once again, the swing high of the range, creating that order block down would be this up close candle, actually my fault. Creating this up, right? And this would be your rejection block here. The swing high and then the swing low would mean this is your reject. This would be your bearish rejection block here, and so forth and so forth. That makes sense. So do we understand the rejection blocks and the order blocks? Do you want me to go over bearish order blocks, or do you guys want me to just move on to we can move on to mitigations and uh breakers? Okay, cool. Mitigation blocks. So generally, this is kind of how your PDRA aspect is going to go. You're going to get your sweep of liquidity, or a high and a low here, high slash low here, right? You're going to get your rejection block next. These are the kind of the orders and where they're going to form. You're going to get your order block next. You're going to get your fair value gap next. Technically, it's going to be a liquidity void here, but we're not going to go over that. You're going to get your fair value gap next. Then it's going to be your breaker, and then it's going to be your mitigation block. Do this mitigation block, and then it'll be the same thing again. Mitigation block, breaker, fair value gap, order block, rejection block, high slash low, right? And this will kind of be how it is. And this will be like your premium. This will be your discounted here, and this will be your premium here, right? We won't go over this too much here, but just keep that in mind. And these are the order the PD arrays are going to form. Now, we're going to go over something that's going to be a little bit interesting when it comes to the breaker and the mitigation block. So we'll go over that really quick and how you can classify a breaker and a mitigation block. Because sometimes you'll see the mitigation block be in the same exact place as where you would see that breaker form. So, and we'll go over the special examples where that happens. But for now, we'll go over the mitigation blocks and the breaker blocks. So generally, a breaker block is going to be a sweep of a high right here and breaks down, right? Breaks down into your market structure point. And now this is where we're going to go over the difference between internal and external kind of breaker blocks and mitigation blocks. So let's say you have a high here, a low here, and then you're going to have another swing high and another swing low here, something like this. We're breaking higher and breaking lower. Now, in this case, where would our breaker block be here? Your breaker block will be at this low still, even if we do have these swing lows here, simply because we cannot classify a new swing low or a new market structure point until we have taken out this previous high. So once we have, for example, if we have taken out this high here, came down, we can consider this our breaker block. But since that did not happen, it's still internal of this range here, right? This is going to be your internal breaker block, and I would much rather be taking your external. So that's going to be your breaker block right here, your mitigation block. And I'm going to go first over in the case of when a mitigation block is going to be in the same place as an order block. But generally, I would not put too much emphasis on this right here. Don't worry too much about this, okay? This will be your mitigation block here, right? And when would I trust this mitigation block to happen? When would I trust this to be a mitigation block is when there's SMT here. So the difference between a mitigation block and a breaker block is a breaker block is going to sweep two sides of liquidity. Your breaker block is going to sweep your buy side, which lies up here, when hopefully up here as well, right? It's going to sweep your buy side here, and so this is a two-sided sweep. While your mitigation block is going to be a one-sided sweep. So the idea is you're not going to see this high get swept here, and you're going to see that stay open. The ideal scenario and the best case scenario, and the only real time I'm going to take a mitigation block is if we see that SMT here, right? And then we come and take the sell side liquidity here. So this is a one-sided sweep. We only swept the sell side here. This is a two-sided sweep where we sweep the buy side, and then we sweep the sell side, and this is how you differentiate between a breaker and a mitigation. Now, since we're only seeing a one-sided sweep here, once price breaks down, creates a swing low, comes back up inside the range somewhere, and then breaks down again, this will be your next mitigation block here, and it will just continue, right? Mitigation block, and let's say we do something like this, right? We have a mitigation block here, right? Since we had a one-sided sweep of external liquidity, came down, right? Came up here. This is your next mitigation block. But let's say this mitigation block fails here. Actually, hold on. This is a bad example. Let me redraw this. Something like this happens. Now you'll have your mitigation block here. And you'll have your order block here. You'll have your breaker block here. And the idea behind this here is that this right here on another time frame is just going to be a one-sided sweep. Since time is fractal, it's going to be a one-sided sweep. And on a lower time frame, let's say on a 5-minute chart or a 2-3-minute chart, this could be your mitigation block here. And inside of a 1-minute, 30-second chart, this will be your breaker block here, right? So this is where this part comes into play here, where you'll have this. Your breaker block form here and your mitigation block form right below that, and that is your ideal situation. So let's go over some live examples here. First of all, do we have any questions about how they're formed or anything like that? What do you mean by definition? Like, what would I define it as? Well, yeah. So basically, it's going to be a for me. It's going to be a one-sided. My best definition would be a one-sided breaker or a one-sided sweep. So since again we sweep one side of liquidity here, right? Especially when it comes to reversal points. When it comes to just like mitigation blocks like this, I don't hold too much value to these. But yes, obviously these are mitigation blocks, right? Because they are one-sided sweeps. And once again, the idea is that old lows and old highs support price lower. So this is the idea behind this mitigation block here, but I wouldn't hold much emphasis to this. My more emphasis would be on the mitigation block here, and I would call this a one-sided sweep here, right? And I'm looking for if this is going to be NQ, this is going to be NQ. I'm 100% looking for ES to do something like this, right? And create this SMT, create this discrepancy here before I'm like, okay, now I can consider this a valid mitigation block, and I'm going to consider this, okay, now this is our reversal point to start going lower. Does that answer your question pretty good? Okay, cool, awesome. So now let's kind of go over our breaker blocks and our rejection blocks here real quick. We'll go over like 1 or 2 examples, and then we'll get on our way. So let me just try and find that one example I was using before for the order blocks and shit. Okay, here, perfect. So here is the idea for your breaker block and for your mitigation block here. So once again here, so if we're looking at this range here, this is our range here, right? High, low, high, low, high, low, high, low, high. So I'm just gonna draw this out real quick so we can kind of understand our ranges here, and then I can kind of explain whatever. And then I can kind of explain how things are, and we can make it look a little better because I think it'll be easier to explain on something like this first. Okay, so now this is basically our range here, right? So let me see what this is here. Okay, and then it'll be something like this. Okay, right? So by definition here, we'll have our first mitigation block, and I'm just clean this up just a little bit here, right? This will be your first mitigation block here, right? And since that is the case here, right, it'd be right here, the swing low. This is going to be your mitigation block, right? Boom, this is your mitigation block right here. And for you guys wondering what this is just your fake bull flag here, right? If you guys care, right? This is your fake bull flag, fake out, break, Judas swing, break out of the bull flag, and then come lower. So this is why you don't trade patterns, but this is going to be your mitigation block here, right? And now, would we consider this here to be our breaker block? Anyone in the chat? Would we consider this to be our breaker block here? Genuine question. Because we have this double-sided sweep here, right? We have this double-sided sweep, right? We have the sweep of buy side, and then we have the sweep of sell side, right? Now, are we going to consider this our breaker? Now, the reason why there is no right or wrong answer here is because this is technically a breaker, but it's going to be an internal breaker, and not one I hold too much value off of. But by definition, your breaker is something like this, right? You're going to see that two-sided sweep here, right? So this is going to be your internal breaker block. Now, I would not hold any emphasis to this at all. Zero. I would hold pretty much zero emphasis here, especially when we have another mitigation block that forms here. But by definition and by patterns, if we want to consider this a pattern, this is technically a breaker. By definition, I would not be considering this a breaker though. You will not catch me classifying this as a breaker, and you'll find me classifying this as a mitigation block because this is our real high, right? Because we made this high, we made a lower low here, and we never broke this high, right? Since we never broke this high, this is all anything inside of this range is all internal, right? Sorry, whoops, internal of this range here. So whatever this is an internal breaker. I wouldn't trust it. And really, when it comes to reversals, you want to be taking those external breaker blocks and those external mitigation blocks. So hopefully that helps you guys there, right? And we'll continue down and follow this range again, right? So we have our next mitigation block form here. Your next mitigation block form here, right? And it just kind of continues to go down lower and lower and lower. And this is why I don't personally like using these mitigation blocks like this, because you're going to have a mitigation block at every single low pretty much. And that's just not how I would be classifying them, right? Because by definition, you would have one at every single low. But the real kind of idea I would have on it is you want to see that mitigation block and be in the smart money reversal, and then you want to see one more happen after that smart money reversal, right? You would have the mitigation block 1 here, mitigation block 2 right here, and that's it. These are going to be your only 2 mitigation blocks I would hold, and I would draw out and I would actually utilize. I would not utilize anything more, like for example, this mitigation block or something, right? I would not be utilizing any of this. Okay, does that make sense to you guys? Now let's go over our bullish breaker here and our bullish mitigation block. So looking at this range here from this high down to this low, right? For the sake of it, we're not going to worry about any of this liquidity here. Don't worry about anything that happened behind the chart here, okay? Don't worry about anything that happened behind the chart here. Now, at this leg right here, at this swing high right here, technically for a bullish breaker, it's going to be on your up close candle, and on your bearish breaker, it's going to be on your down close candle, right? But for this case here, is this going to be your breaker block, or is this going to be your fair value gap, or is this going to be your mitigation block here? Anyone have an idea? If the chat wants to say, is this here going to be your mitigation block, or is this here going to be your breaker block here? Yeah, great. This is going to be your breaker block here. And why are we considering this your breaker block? Well, we can see we have our swing high here, right? We broke this low here, right? And now you have, once you guys see we break the swing low point inside of this range, you look for your next swing low point to be made. And this is here, right? And since this swing low point is below this swing low point, this can be classified as our external breaker block once we make this swing high point one more time. Now this is our external breaker, and you can see right here what price does off of this breaker here, right? Boom. And once again, if we're going off of this again with the high low, right? Rejection block, order block, fair value gap, breaker block, and mitigation block, right? Where would our mitigation block be in this range here? This high to this low, right? Would we have a mitigation block here or not? Would we have a mitigation block or would we not have a mitigation block? What do you guys think? Actually, so in this case, we would have a mitigation block here. Because once again, remember guys, when I said time is fractal here, right? And we're going to use that idea when it comes to mitigation blocks. So this is going to be a mitigation block right here, right? So at this high here, it's going to be our mitigation block here, right? And this is going to be our mitigation, and that'll technically be these two up close candles here, since it's going to be a bullish mitigation. So why are we considering this a bullish mitigation? Let's come to the 2-minute chart real quick. Do we see anything here in the 2-minute chart down here in terms of a breaker? No. So again, if we're ignoring everything behind here, right? This right here is going to be your mitigation block on the 1-minute chart as well. Because time is fractal, we're going to have one here as well, and it's going to be your one-sided delivery. It's going to be down and up, right? It's going to be your one-sided delivery. Does that make sense here? It's pretty much going to be like, yeah, something like that. It's going to be like this. So this is going to be your mitigation block here, right? And once again, this reinforces the idea that your mitigation block comes after your breaker. This is your one-sided delivery here, just like that. While as your breaker, you'll have something like this. Okay. Now, do we have any more questions about any of the blocks, any of the blocks at all? For what it's worth, your actual block would be here. My block is a 2-handle candle. Okay, if we don't have any more questions about our mitigation blocks here, now breaker blocks here, I'm gonna wrap things up here. Actually, let me see if I can show you guys a good example of an SMT mitigation block or some shit. Let me see if I can find a good one. No, we'd have to do some digging. Because I know there was a shit ton of SMT, like. I'm going to crash out. Ah, yes, this is a perfect example. So I actually took a trade off this SMT here, right? And this is going to be your breaker block here. Now, this is actually another good learning experience here. So this is when you have a lot of down close candles here, right? And your down close candle is not the swing low here. How do we classify which down close candle here is going to be the breaker? Well, you're going to look for the inside of this range here. You're going to look for which down close candle has the lowest body, right? The lowest body close. In this case, it would be this candle here. So you use this, you will use this candle's wick here, and this will be your breaker block, right? Now let's come over to ES here. So let me show you guys this real quick, right? SMT up here, right? So what can we classify this as here on ES? Since we have this SMT here, we can finally classify this as our mitigation block, right? And which one would it be? We made the swing low here, we made a lower low, swing low right here. The down close candle is right here. And this is your mitigation block here on ES. Does that make sense? Okay, cool. Now, for anyone who cares, right, a little bit of sauce. Let me see when this was. When was that here? That was here. Okay. So this is your idea here, right? For your perfect market maker model here, right? Your ideal market maker setup here, right? You have your rejection block form here, right? We're inside a 15-minute fair value gap. We're inside literally every fucking time frame fair value gap you can imagine, right? Rejection block forms here at this high here. Price comes, touches your rejection block here. I think it'll be better on Q. Yeah, it would be better in NQ because this is a bad example. Okay, perfect. So you create your rejection block here. Right? Remember what I said when you have this imbalance here, it's going to be these collective things right here, right? So once again, what did I say your perfect market maker model is going to look like? Right? It's going to look a high and a low. Your rejection block, your order block, liquidity void. Okay, sure, but we're going to skip over that. Fair value gap, breaker block, and mitigation block. Right? This is just a little bit of sauce outside of the fucking class. But anyways, right? You have your high and low here formed. Boom. You have your high and low up top here. Swept that liquidity. Came down. What is this right here? What did we also react off of here? Rejection block. Right? So boom. Where is it? Where is it? Fuck. Rejection block here, right? So we checked off the first two. Now, what do we see happen next? We see your order block, right? You can consider either this your order block here, but since we are in the higher time frame, we can consider this your order block here, right? Next, you're going to see your fair value gap, right? We see the fair value gap happen here. Right? And then you see your breaker block form here. And then price comes lower, right? What's right here? This is your mitigation block right here. This is your mitigation block. See price, things around here, falls. You can also see that price is staying below the midpoint of this, or the bodies are staying below the midpoint of this here, right? So what is this? This is our ideal and pretty much perfect market maker sell model here. You have your rejection block here, breaks down, fair value gap, bodies stay. Look, where do the wicks go, right? The wicks go to the breaker, but we first come into the fair value gap here. Look where the bodies are. They stay inside the fair value gap here. Actually, you'll actually use the volume imbalances here and up here, right? Your fair value gap, where do the bodies stay? Inside the fair value gap. Where do the wicks go to? Right back to this breaker block. One more time back to this order block here. Falls. Where do we go to next? Mitigation block right here. Come back up. And we fall down. And where do we go? Where is our original consolidation? Down here. And this is your perfect market maker sell model. So where can you enter off this market maker sell model? You have two entries here, right? Well, you have a couple entries here. You have your SMT and your sweep here, right? So this is happening at the same time as the rejection block. So there are absolutely zero entries going on over here, right? Unless you're planning to turtle soup this here, you're not going to see any entries come into here. Now, your first entry can be off this inverse fair value gap here. If you're once this gets inversed, yeah, this could be your first one. I personally would not do this, right? And the idea is again that we go from the high to low to the rejection block to the order block to the fair value gap, and this is why we left this here as a breakaway gap. Right? Yeah, and this is also your balanced price range, but with the idea of this being a sell model, right, and a perfect sell model at that, right, we're expecting this to be a breakaway gap, right? Where can you take your first entry? Hold on. Anyways, back here, right? Your first entry, your low risk sell here, is going to be on the order block here, right here. This is going to be your first sell point. Now, where do you put your stop loss? You can be safe. You can put above this high, and this would be your really safe option here. But you can also anticipate this to be your breakaway gap. And what you'll do here is you'll take the low of this wick here to the high of this wick here, find your midpoint, and that's your aggressive stop loss placement right there, right? And this is what's going to be known as your low risk sell right here inside of this order block. This is your low risk sell. Next, where's your next entry at? Well, your next entry, right? If you're assuming it's going to be the fair value gap, your next entry would be right here. Right now, what do you have to encompass since in your sell model, it's supposed to go fair value gap, then it's supposed to come into a breaker, right? We have our breaker formed here, so we have to allow room for price to come into our breaker here, right? So what can we do? We can just put out our stop loss above this high here, what's top of this breaker right here, just like this. This is your second entry possibility here, right? Not only have you shifted that structure and you're taking the fair value gap here, 2022 model, right? You also have your breaker block here. And this is the case where you have to allow price to be able to come up and trade into this breaker block here. Okay. In this case, you have your order block here protecting you, your breaker block, and your fair value gap, right? Now, let's say you missed this fair value gap move. Where's your next possible entry? On this breaker block here, right? This is actually where I entered on my trade. And you can take it down to whatever here. There was an end walk here. I took it off here, but this is going to be your next entry because after the fair value gap, it's going to come into the breaker. Now, and the idea is that when you have your unicorn, it comes into the fair value gap, then the breaker, and that qualifies this, right? Order block, fair value gap, then the breaker, and that's your unicorn. In this case, we have the fair value gap first, then we have the breaker, right? Break slower. Let's say you missed it, right? Let's say you missed this fair value gap in your breaker block. Your final opportunity to get in the first stage of distribution is going to be this mitigation block here. So where would you enter? You have your mitigation block. You have your fair value gap. You would encompass the volume imbalance here in this fair value gap. All right, encompass the fair value gap with the volume imbalance, right? And you have your order block here, right? So where's your second entry here? On the mitigation block. Where's your stop loss? Stop loss is going to be at the swing high of the order block because price should not trade higher and take out the short-term high here. And this is your final entry before price breaks down. Now, where do you get in for your second stage of distribution here? Actually, you're lucky the market gives you one more opportunity right fucking here. And this is in the macro. Right, so the market offers you that one opportunity. One more time. After you miss this here, inside the macro, and this at 952. 950 to 1010 macro. That's your next entry, right? Breaks lower. Now you don't get another entry into your second stage distribution, right? So where's your second stage distribution going to be? It's going to be here, right? So where are you going to enter here? You can enter right here on this fair value gap. Now, would I do that? No. How would I enter my second stage of distribution here? I'm going to wait for a 5-minute or 15-minute fair value gap to come into here, right? Because you don't know how far price can actually come back up, right? Where the fuck was that? Okay, that was here, right? You don't know how far price can come back up. Price can come back up all the way up to here if it wanted to. It can come up back up to here, right? Before coming down to reach these lows, right? So how can we qualify this? Ideally for me, I wait for a 5-minute time frame here. Unfortunately, you don't quite get that on this leg down here, right? So for me, this is not a trade. Now, where can you technically find a trade here? You find a trade up here. Inside this 5-minute fair value gap here, you take your SMT here. Now, this happens to be a 15-minute as well, right? And you can take a fair value gap down here, right? Targeting these lows. So once you see that our original consolidation or our OC lows were taken here, right? Now there is a chance that price doesn't have to come any lower. We finished our market maker sell model, right? But I still wanted to get an opportunity here, right? And you can see that happen here, right? And what can we see? What can we see here happen once again, right? You see your high get taken here. Your high gets taken here. You're in this rejection block here, right? Now we fail to kind of, well, I guess we come into an order block here, come into your fair value gap here, right? And then break lower. Now, where would our breaker block point be? Our breaker block point would be here. So since we didn't come and create this breaker block to finish our sell model, this is where we finished right here, right on this rejection block. Right? And what do you guys see happen again? You have the rejection block here, right? What do you see? You see your order block here. What do we see after the order block here? You see your fair value gap and your breaker block would be up here. To your fair value gap, and eventually you see your breaker block here. Right? So this is a mini sell model here. And you'll probably see in like a 30-second time frame or a 15-second time frame, this looks a lot cleaner here. Right? So you'll probably see the order block and the fair value gap come into here. You'll see a breaker somewhere here, and you'll see that rejection come down into the rejection block here. Rejection block, order block, fair value gap, right? Why is this not our breaker block here? Right? High, low, higher, high, right? This is your low here. This is still our inputted low here. Breaks up, comes down, fails to take out this low. So this is not your breaker block. This would be your breaker block. This would be your mitigation block, right? And what did we say again in our ideal scenario here, right? And note there was no SMT here. Actually, no, there was SMT here. My fault. There was SMT here. So note that there was SMT here, right? So now we can trust this mitigation block. But if we're actually predicting a market maker buy model to form, right? Again, it's supposed to make that breaker, then the mitigation. Now we classified this as the SMT here. Cool. We could technically see that happen. By definition, that's not supposed to happen here, right? Not only did we fail to make the breaker block, right, before the mitigation block, we also failed to take the low. Now, there's nothing wrong with this happening, and we can definitely still see a model out of this. It's just you're going to see your buy model, your better buy model. That's going to be on ES, because what is ES also doing? ES is also taking out the high, taking out the low here. Since it took out the low, we're going to have our breaker block here, right? And you're going to have your mitigation block up here, and that's going to form your better buy model. In this case, we don't have a really great buy model, but you can kind of see exactly what happens. Your rejection block, next comes your order block, next comes your fair value gap. In the case of ES, here would be its breaker block somewhere. In the case of here, this was our breaker block here. And we can see, since we made this mitigation block, we sort of failed to finish this buy model. So what are we going to do? Are we going to try it again? We could try it again here, right? But we failed to come into this rejection block here, and we failed to come into a low here. So we cannot be classifying this as anything here. And right, you can see that exactly happened here, right? And you can see us kind of fail to react off of this order block, right? Fail to react off of this fair value gap. That's why we fell here. But what can we see about this pump up here, right? Well, we have our new rejection block down here, right? I don't know if we actually had SMT here. I don't quite remember that, but we have a rejection block here. This high and the low can be, as long as there's SMT here, right? We don't have to do this high and the low here, right? We can simply go off the rejection block. Rejection block here. Reacts off the order block here, right? Continues higher, right? this case, this is going to be your mitigation block here, right? This is going to be your fair value gap. Well, you have all these fair value gaps here, right? Which one do you choose? It's kind of hard to say, right? But in the case of, you're supposed to see that fair value gap come into play before the breaker and the mitigation block. Since we have that mitigation block here, it's really hard to say which one you're going to see hit, right? We end up seeing this one hit. This is all hindsight with this fair value gap here. But ideally, you would wait for this mitigation block. So you probably get in somewhere like here at this mitigation block, right? And then this is finishing your sell model back up to there. Right, and what do you have in here? You have your sweep. You have your rejection block, right? Again, right, what do you have here? You have your order block come into play right here, right? Yeah, you could also use this one here if you wanted to. Not a big deal. Either one works. Order block here. So what do we have? High and a high or low, rejection block, order block. What's supposed to come after the order block? Fair value gap. Boom, fair value gap. Then your breaker. Now we didn't come into the breaker, but right, we just have that breaker. And then what do we finally have? Your mitigation block up here. Okay, and this is pretty much how your model, your buy model and your sell model is supposed to work. And this is why I thought today was super good. I thought Friday was a super good day because it was just buy model after buy model after buy model. Okay, so just a little fucking sauce for you guys. I'm not answering any fucking questions about this. I'm done. I'm gonna go make fucking lunch.